This week's number, 6 million. That's how much Miami Nightclub 11 raked in last year in crypto payments. But in the last few months, that number is $10,000 in crypto payments. True story, my father told me to never go to a strip club as I may see something that upsets me. He was right. I went into a strip club and saw my dad. Welcome to Prof G Markets. Today, we're discussing Crowdstrike in the cybersecurity industry, the continued misadventures of Elon Musk, and an unpack on bankruptcies. Here with the news is Prof G media analyst Ed Elson. Ed, let's light this candle.
Speaking of nightclubs, Scott, Prof G Media is going clubbing tomorrow, and the question everyone's asking is, will Scott Galloway be joining us? Can you speak on that?
100% no. I think at this point in my life, nothing good can come from me going out late night to a club, which is kind of a raunchy vaudeville with alcohol around. There's literally
bonding.
Nothing but downside. No, you should bond with each other.
Yeah, well, we have a lot of plans to try to convince you to come.
Yeah.
Most of them
good luck
based
with
around
that.
alcohol.
But here's the key. The key part of me will come, specifically my black card. That's right.
Yeah.
Daddy has an Amex Centurion so he can signal to women that if they have sex with me, the kids are more likely to survive than if they have sex with someone carrying a Discover card. You're throwing down black tomorrow, Ed. You're
I don't know
going
why
in with
you
a
can
black
say
card.
that, but you can't come with us to a club.
I'm being very serious here, and this is a lesson to bosses, or I don't know. At my age, you just shouldn't be partying with the team. You should be nice. You should have dinner. You should outline the strategy. Because here's the thing: you're all very impressed by me, and when you see me drunk, you would be uber impressed because I'm actually a better version of me with a little bit of the devil water. But no, I don't have much of a desire to party with any of you, and I also. Again, see above, don't see a whole lot of upside. And also, you guys want to be able to get fucked up and not worry about what I think about you.
Well, I'm a great version of myself drunk, so
are you?
We'll see. Yeah.
I'm very judgmental. If anyone gets sloppy, I'll be like, memo to self, never let them be a manager. So yeah, you're on your own. But anyways.
Okay, we'll see about that next week. Let's get into it. Let's start with our weekly review of market vitals. The S&P 500 rallied on signs inflation might be easing. The dollar ended November down almost 5% after registering gains for the first 10 months of the year. Bitcoin climbed modestly, but is still down around 20% for the month. And the yield curve inversion between long-term and short-term Treasury bonds continued to deepen, shifting to the headlines. The three major indexes closed out their second straight month of gains after Jerome Powell signaled interest rate hikes will start to slow this month. Over in the Eurozone, inflation slowed for the first time in 17 months. Meanwhile, the European Central Bank issued a statement on Bitcoin, arguing the cryptocurrency is taking its, quote, artificially induced last gasp before the road to irrelevance. And finally, against his lawyer's advice, Sam Bankman-Fried, the former CEO of FTX, spoke virtually at the New York Times DealBook Summit. He said he, quote, never tried to commit fraud at FTX. Scott, you were there at the summit. What did you think of that interview?
I couldn't believe he did it. If I was he's so young that I can't help but feel paternal. And if I were his father, I would have flown down to the Bahamas and physically prevented him from doing this interview. He is more likely to go to jail because of this interview. He is more likely to spend more time in jail because of this interview. Not necessarily because he was terrible, but because he's in such hot water that there's just no upside to any impromptu, non-controlled communication right now. And the lesson to young people is if you are ever under investigation for anything, do not do anything without having your lawyer present. They are not your friends. He is not going to win over the media or the public at this point. He has lost so much capital. He's living in a Bahamas penthouse apartment with a bunch of his friends, deciding he's too cool to shower. And I just think the media and so many people lost so much money, they're coming for him, and they want a blood offering. They want to see this guy in an orange jumpsuit. And anything he says or does right now is just evidence to confirm the district attorney's case or to contradict or weaken any argument he has. Mm-hmm. The question everyone was asking after the interview was, do you believe him? Mm-hmm. And I do believe him, but I still think he's going to jail. I think what's more interesting here is not a 30-year-old commingling funds and potentially committing fraud, but that we produce these individuals who develop this Jesus-like complex where, because they're in an environment where they can make $30 or $40 billion, or supposedly be worth $30 or $40 billion, because of this idolatry of innovators, where we're hoping some kid from MIT who talks about long-termism and conscious capitalism, we want to believe that he's the next Jesus Christ. Mm-hmm. And people invest their life savings in an entity that's not regulated, where he's promising things that are too good to be true. And he probably thought, I'm not really committing fraud. I'm cross-collateralizing assets that are going up in value, and everyone will win, and I'll give more money to charity. But he became, the way I would describe it is, he became delusional. He probably convinced himself he wasn't committing fraud. Mm-hmm. So, I think he believes he tried his best and wasn't doing anything wrong. And I think to a certain extent, when we tell, and I've just said this, when you tell a 30-something-year-old man he's Jesus Christ, he's inclined to believe you. And the fact we don't have regulation around companies that take in people's life savings, the fact that we're willing to put this much faith in the brilliance of these tech innovators, he's going to jail. But I think our society and the idolatry of innovators is also culpable. I think we're going to continue to produce these kinds of individuals. I don't think this is Bernie Madoff. Bernie Madoff knew he was committing a crime. He knew that was his strategy. I don't think that was his strategy here. I think he got in over his skis and became delusional around his own abilities and the marketplace. When a guy is in the Bahamas hanging out in a penthouse, trading billions of dollars, supposedly making tens of billions of dollars in wealth, only taking breaks to come meet with financial icons and the most important people in finance who fillet him, it's pretty easy to start thinking anything you do is not in fact illegal, but just smart business strategy. I found it fascinating. He was stupid to do this interview, and I think he's just a manifestation of our idolatry of innovators. Mm-hmm.
Cybersecurity firm Crowdstrike posted its third quarter earnings, and it was a beat. The company reported $581 million in revenue versus $574 million expected, and earnings per share of 40 cents. That was 30% higher than analysts' estimates. What's strange, though, is that the stock collapsed. Crowdstrike shares were down almost 20% after that earnings call. So, Scott, why do you think the stock fell on such strong earnings?
So a stock price is not only a function of the performance of the company, but the expectations around the performance. And even though this was an earnings beat, analysts look at specific metrics. Specifically in this case, they look at annual recurring revenue, and specifically here on net new annual recurring revenue. That is revenue generated from new business acquisitions. And these were weaker than expected. CrowdStrike added 1,500 new customers this quarter versus 1,600 last year. They had strong subscription revenue. Their annual recurring revenue was $2.34 billion, which was up 54% year on year. And 40 U.S. state governments are now CrowdStrike customers. Think of that. Almost every state is a customer. And the net retention was at its highest level in 7 quarters. But they got spooked by the ARR number not being as high as they'd like. Now, the learning is stock prices are a function of expectations. This might have been a stock that just got out over its skis. It's still an incredible company. But maybe the stock just got too rich. And also, since its crash yesterday, it's recovered a lot of that ground. Another learning, in any business, you want to attempt to distill it down to 2 key metrics, what I call logo renewal and dollar renewal. You want to think like a software company, even if you're not a software company. Now, what are those metrics? Logo renewal is the percentage of clients that stick around in year 2 that were in year 1. And dollar renewal is how much money do you get from those retained clients versus the revenue of that whole base the previous year. So you're a company that has 100 customers or 100 clients. 90 of them are customers in year 2, so you have a 90% logo renewal. Of those 90 returning clients or customers, they spend on average 20% more in year 2. You want to grow your revenues. You want to have additional offerings. 90 times 1.2 is 108. So what does that mean? We have logo renewal of 90% and dollar renewal of 108%. Whenever you get sort of to 80 and 100 plus around logo and dollar renewal, you have a company that begins to look, smell, and feel like a software company, and more importantly, begins to get valued like a software company. But it's a good way to think about a business. How do I hold on to as many clients as possible, and how do I increase the revenue amongst those retained clients? And I'm going to measure that through logo and dollar renewal.
And just on cybersecurity itself, I mean, I think back to a year ago, and ransomware attacks was the it topic. It was all over the news. There was the Colonial Pipeline attack. And all these cybersecurity companies seemed like the future. But now, cybersecurity as an index, it's down 23% year to date. That's compared to the S&P, which is down 14%. Do you think that cybersecurity, at least a year ago, do you think the market a year ago was sort of overreacting to these ransomware attacks? Or do you think that cybersecurity is going to continue to be a lasting and enduring industry?
I think the answer is yes. Netflix and Tesla are both incredible companies with incredible products, and one went peak to trough down 75%, and Tesla's off 50% this year because, simply put, the valuation on the company's equity got out ahead of the business. That the underlying stock price just reflected expectations that were unreasonable. And you're right, cybersecurity was everywhere. Cybersecurity was going to be the new defense and garner the type of spending that our Defense Department spends on different weapon systems and manufacturers. And sure, this is an incredible business. It's come off a bit, but there's just no getting around it. If you're thinking about an interesting career that's going to grow, I mean, cybersecurity, I think, is going to be the gift that keeps on giving for a long time.
Mm-hmm. Yeah, one of the things that Crowdstrike mentioned was this idea of macro headwinds, and you've been talking a lot about how that relates to the advertising industry, specifically that when things are tough, the first budget that companies cut are their marketing budgets because it's sort of seen as an almost excessive cost. Do you think of cybersecurity the same way here? Do you think that macro headwinds might cause a company to say, okay, maybe we don't need to put this much in the cybersecurity budget, we don't need it at all? Or do you think it's maybe more of an integral part of these companies?
I would argue this is probably more recession-proof, the cybersecurity sector, than the majority of quote-unquote discretionary. I mean, your cybersecurity investments, cut that at your own risk. Yeah. Because this does feel, I'd be shocked if they didn't pitch this to analysts, or their investor relations department didn't have didn't repeat over and over in their IR PowerPoint presentations that this company should be recession-proof, because I just don't think you want to cut your cybersecurity. That's like, okay, what makes for an ugly earnings call is our revenues are down 10% and we were hacked. That just doesn't, that doesn't play well. So cybersecurity, that feels to me like not a discretionary item.
Elon Musk continues to stir the pot on Twitter. His latest controversy involves Apple, alleging that the company stopped advertising on the social media platform. Elon claimed the company, quote, hates free speech, and that it was threatening to take Twitter off the App Store. He also brought attention to the 30% cut Apple takes on all paid apps. And then later, though, Elon tweeted a video walking around Apple's HQ. He said, quote, thanks, Tim Cook, for taking me around. We resolved the misunderstanding about Twitter potentially being removed from the App Store. Tim was clear that Apple never considered doing so. So, Scott, it seemed like Elon was trying to wage a war against Apple, apparently no longer. What do you think happened there?
I don't know. As evidence, more bullshit. See above Elon Musk. I generally think that Elon and Trump share this need or genius to be in the news every 48 hours, and will say anything. There was nothing here. There was no. Apple never threatened to boot Twitter off. And when Elon Musk says that Apple hates free speech, like, where does he even come up with that? And there's something that's disappointing here, and there's a lesson. What's disappointing is the politicization of everything. Immediately, a bunch of right-wing weirdos weighed in and said that, oh, Apple, this would be the end. Someone said the worst thing. This would be the worst thing that happened in civilization. Some Republican whack job. We just rather than having a discussion around the issues and data and having a thoughtful conversation, everyone wants to say, is that company, is that idea, is that vaccine red or blue? And if so, I hate everything about it, or it can do no wrong. And that's the same thing here, the same bullshit here. And the lesson here is that Tim Cook doesn't take the bait. He doesn't tweet back, Elon, you're a fucking idiot. This has nothing to do with free speech. You don't understand what free speech means. And there's no evidence of anything you're saying, as always, and you're doing nothing but posing for the rage machine here. Instead, he says, hey, Elon, come on down to HQ, walks him around, pretends to not be, pretends that he doesn't make his skin crawl. I imagine he enjoyed meeting with Elon about as much as Tim Cook enjoys meeting with President Trump. And then Musk walks away and says, oh, what a great guy and a great company. I just think Tim Cook is he's the man you want to be. He doesn't take the bait. Fine, I'll take the punch. I don't need to win. Bring him down. Just nod your head, pose for the camera, and let the child, let the angry genius math kid go back to whatever he does, twisting his legs off his G.I. Joe or kicking the dog. So, there were two people were in that meeting. One is a man. Oh my God, that was indignant. Anyways, Ed, your thoughts?
Well, I just wanted to know whether you thought he sort of made it up and just was causing a hissy fit, and it sounds like you do think that. But one thing that you were saying earlier this week was that all this Twitter obsession is sort of a distraction, and that the real thing we should be focusing on is sort of the after effects of Elon's behavior, specifically what's going to happen to Tesla. Could you speak more on that and your thoughts there?
Yeah, there's a few. It's always the knock-on effects that are most interesting. There's a few things. First off, Twitter, and I thought the site was going to go down, and it hasn't. Twitter's kind of minimum acceptable standard, if you will, for operating Twitter is probably can be done with 1,000 or 1,500 people, not 7,000. And so I just can't believe that hasn't escaped the notice or attention of every other tech company. And I think you're going to see really significant layoffs. And people keep asking, when is it going to be over? Because they keep hearing about layoffs at other firms. I think DoorDash has laid off 1,250 people. I think we're just getting started, because my colleague Aswat Damodaran has a book coming out on life cycles, and he says when a company is young and kind of perennially a teenager and always growing, it's hard for them to acknowledge that they're a mature boomer. And these companies have grown every year. They kept hiring. They kept getting more and more profitable despite how much they spent on SG&A or people or new hires. And that's no longer the case. And then they look over there and go, wait, Twitter appears to be, from a consumer standpoint, operating fine on 25% of the workforce. They're probably going to lay off about 75% of the workforce. Now, having said that, I also need to acknowledge that the revenue side is probably going to decline fast, as precipitously or even more dramatically than the cost they're cutting. He's basically cutting his way to a $1 or $2 billion business that's worth $5 billion. So this doesn't make any sense from a business strategy standpoint, but the layoffs here of whatever it'll end up being, 3,000 to 5,000 people, will mean 300 to 500,000 layoffs elsewhere as companies begin to think, oh, wait, maybe with advances in cloud, we don't need all of these people. In addition, as we all obsess over Twitter and the value destruction there, the real value destruction is going to take place at Tesla. And there's been some interesting data that has come out that says that the brand value of both Twitter and Tesla has taken a real drawdown, a real step down, a real hit, especially among Democrats. And it's kind of modestly up or neutral among Republicans. But both these brands have taken just an enormous hit because of Musk's antics. And so you have the perfect storm of bad things for Twitter. One, people are looking for excuses to pull media because they have a lot more options. But also, while he's probably lost his entire equity investment, or $32 billion, or 31 of that $45 billion, he's going to lose 7 times that at Tesla when Tesla goes from $600 billion in market cap to $300 over the next 6 months, because the Tesla brand has become associated with an individual who has done a hard right turn and has politicized Tesla. I sold my Tesla, and I think you're going to see a lot of people decide not to buy a Tesla. And then you add in the fact that it's gone from basically shitty alternatives, the Pontiac Leaf or whatever the other electric car was, to BMW, Mercedes, Range Rover's coming out with an electric car next year. There's competition, and the brand has taken a hit at exactly the wrong time. So while we all obsess over the decline or the destruction of value at Twitter, where you're going to see real destruction in shareholder value is going to be over at Tesla, because, in large part, because of Musk's behavior around Twitter.
Mm-hmm. Yeah, just the numbers that Scott was mentioning there, Twitter favorability among Democrats has fallen 18%, and then for Tesla it's down 20%. And then for Republicans, favorability is up 5.5% for Twitter and up 4% for Tesla. But it sounds like you think that brand value is a crucial part of Tesla's business. I mean, you just said, they're going to go from 600 billion to 300 billion. Are you suggesting that the politicization of Tesla is what will take its equity value down by like 50%?
I think other than maybe the college you went to, a car is the ultimate expression of your own brand. There's a tremendous self-expressive benefit, or lack thereof, that goes into your decision around a car. When I choose to drive a Range Rover, I'm choosing to say I'm British, I have money, I have class, I'm in the middle of a midlife crisis. When I chose to have BMWs for 15 years straight, I had 3 7 Series, I was saying I'm youthful, masculine, and aggressive. When I had a Tesla, it said I'm rich, but I care about the environment, have sex with me. I think that's the ultimate midlife crisis car. So people think a lot about, you're selling 3,500 pounds of glass, steel, and rubber, but what you're really selling is a statement about who you are, otherwise everyone would just buy a Toyota, and a lot of people do buy a Toyota. But especially once you get into the higher margin luxury cars, you're saying something, or you're trying to say something. Mm-hmm. And there hasn't been a brand, maybe other than Air Jordans or Tom Ford, that is more closely linked with an individual. And this individual has become totally politicized. And also there's a large cohort, I believe, of Americans that don't want anything to do with this individual and aren't impressed by him. And then when you all of a sudden can buy an electric i7 or a Porsche Taycan, all of a sudden there are alternatives, and there didn't used to be. So I think it's a perfect storm of bad things for Tesla. And by the way, I think Tesla will experience record revenues, record deliveries, and their stock will still get cut in half. And it'll still be, even with a drawdown of 50% in the company's stock price, it'll still be worth more than the entire German and American auto industries combined. This is a stock that's already off 50%, but I think it'll be off 75%, or put another way, it gets cut in half and then cut in half again. And the proxy here is Netflix. Netflix went peak to trough down 75% and then recovered and is now down, I think, about 52%. But the business cycle is eerily similar here, and that is Netflix was the leader. They inspired an entirely new category, similar to what Tesla has done with EVs. But they didn't have any competition. Everyone was so busy holding on to their legacy businesses and trying to respond and get different points of the channel to coordinate around what it meant for not having movies to come out in movies first, to find the capital to make the sort of investments to go toe-to-toe with Netflix. And Netflix essentially for almost or a better part of a decade had no competition. All of these attributes, all of these dynamics were at play with Tesla. And then what happened with Netflix? Everybody came in, and the stock shed 3/4 of its value. We're seeing what happened to Netflix play out with Tesla, just with a 24-month lag.
Yeah. So far, Twitter's problems are short-term or hypothetical. But if things go from bad to worse, one possible outcome is bankruptcy. If that sounds alarmist, well, blame Elon. 2 weeks ago, he told Twitter employees that bankruptcy, quote, isn't out of the question. Meanwhile, bankruptcy is very much not hypothetical for a number of crypto companies, most famously Sam Bankman-Fried's FTX. So we thought this was a good time to learn more about how bankruptcy actually works. Here with this week's Unpack is Prof G Media's editor-in-chief, Jason Stavers.
Ed, as you can probably guess, companies face bankruptcy when they can't pay their debts. But that can mean a lot of things because companies usually have a lot of different kinds of debt. They take out loans from banks, but they also issue debt in the form of bonds, which require semi-annual payments. They buy most of their materials and equipment on credit. They have to make payroll every 2 weeks. And they make payments on leases, regular tax payments, insurance premiums, a lot of different creditors. And when there isn't enough money coming in to make those payments, they have to pick and choose which creditors to pay, and that can get ugly fast. Each creditor has different means of putting pressure on the company to pay up, from charging more fees to going in and seizing equipment or goods. So bankruptcy at its heart, it's a way to call time out, bring all those creditors together under the management of a federal court, and work out an equitable solution. A company can put itself in bankruptcy, or a creditor can go to court itself and ask the court to compel the debtor into bankruptcy.
And just to be clear, the debtor is the company that owes the money.
Right. So debtors are entities that owe debt. And on the flip side, creditors are the banks and vendors and everyone else that extend credit. Mm-hmm. You might be a shoe company or an apple farm, but once you go into bankruptcy, you're a debtor. So once the paperwork is filed, a few important things happen. All of those nasty collections tactics, they're put on hold. Offices can stay open. Nobody will come to repossess your factory equipment or servers, which is why you might hear that a company like Brooks Brothers or J. Crew is bankrupt, but their stores remain open. Banks will typically provide short-term loans to pay necessary expenses because they know the court will ensure that those emergency loans get paid back first. And finally, the lawyers and the accountants, they just get some breathing room in bankruptcy to sort out the mess.
So how does the company get out of bankruptcy?
Two things have to happen. First, the company and its creditors agree on a plan. Who gets paid how much, and what steps the company will take to ensure it can actually make those payments in the future. Sometimes an outside investor is brought in who agrees to invest cash in the company in exchange for new shares. Negotiating this whole plan can be a huge undertaking because companies tend to have such a wide variety of creditors. So to make the process manageable, the court typically creates one or more committees, each one representing a different group of similar creditors. These committees, they handle negotiations on behalf of similar creditors. And eventually, the groups all agree on a plan, the creditors vote, and if the plan gets enough votes, it goes to the judge. Then the judge hears any objections to the plan. They might require some changes. And then once the judge approves it, the company is out of bankruptcy and returning to regular operations.
Well, that sounds pretty great, right? Like maybe even too great, too good to be true.
Yeah, there are some downsides. So one major downside is that this is just really expensive. A lot of lawyers and a lot of accountants billing hundreds of dollars per hour. And there's a lot for them to do because bankruptcy courts require regular, detailed reporting about a company's operations, much more reporting than is required by, say, the SEC. And plan negotiations can be intense. Often there are disputes between different groups of creditors which go before the judge. Sometimes, in fact, quite often, there are related lawsuits that have to get prosecuted, and all of that generates more costs. And it can take years. Finally, declaring bankruptcy can be detrimental to a company's brand, right? It gets pretty hard to sign up new customers or retain your best employees if the news is full of stories about how you're bankrupt. The biggest downside, though, can be the risks to the owners and the managers of the company. The owners of the company, the shareholders in a public company, they are last in line. So if there's not enough money to pay the company's debts, which is usually the case because that's why the company's in bankruptcy, shareholders are generally not on the hook to pay those debts, but they can lose some or all of their equity. In a worst-case scenario, the company is sold to new investors. The proceeds from that sale are used to pay off the debts, and the shareholders get nothing. They no longer own the company. They don't get any money for their shares. Similarly, if the company's creditors are not happy with management, they can demand management be fired as part of the plan of reorganization. And in extreme cases, the court itself will put the company under the management of a trustee. And finally, there's a lot of detailed reporting, right? So if management has been up to no good, or if the shareholders in a private business have been cooking the books, that's very likely to come out in the bankruptcy proceeding. So not all bankruptcies are the same, right? You can think of them on a spectrum. At one end, you have what's known as a free fall bankruptcy. This is when a company or creditor just shows up in court one day and says, surprise, we're screwed, no money. Now, that's not ideal. It's messy, people get angry, there's a lot of surprises. At the other end of the spectrum, the company and its creditors, they get together before getting the court involved. They negotiate a plan, and if things go well, they may not need to file bankruptcy at all. If you hear that a company has reorganized, then that means something like this has taken place. Sometimes, though, that happens, but the plan still needs the approval of the court. Most often because there are holdouts. There might be a few creditors who aren't willing to restructure their debt the way all the others are. And so the people who want the plan to succeed will go into court and they'll get a judge to order those holdouts to accept the new plan, which the judge can do if they're in bankruptcy. Another thing that sometimes happens is that for whatever reason, the parties might be concerned they're going to get sued over the plan. Shareholders might not like that their equity got cut down or something else. And so they'll go to court in a bankruptcy proceeding. The judge will essentially bless the plan, and that will potentially protect them from lawsuits. So when that happens, when the plan is in place, but they just need to get a judge to approve it, that's what's known as a pre-packaged bankruptcy, or pre-pack. These are typically resolved in a few months. They're a lot less expensive than a free-fall bankruptcy. And there's even been a few cases where the filing and final approval of a pre-pack was handled in a single day. Now, most bankruptcies are somewhere between a pre-pack and a free-fall. The company has started negotiating with its creditors. There's some points of agreement, but they need the court to get the final deal done. And you really want to be as close to the pre-pack end of the spectrum as possible. Two things make that hard, though. The diversity of your creditors. If you have a lot of creditors who are different kinds of businesses with different kinds of interests, it's just hard to get them all together around a table to negotiate a plan without the aid of the bankruptcy court. And then second, it's what kind of problems the company has. If a company's problems are mostly operational, if its business model is broken, if its products just aren't very good, that's kind of hard to fix sitting around a negotiating table with lawyers. And so those kinds of situations usually end up in long, complicated bankruptcies. If the problems are simply capital structure, financing problems, debt payments are too high, interest rates have kind of caught the company out a little bit, you can usually negotiate those in good faith with your creditors, and you may not need to go to court at all.
So with this spectrum, I assume FTX sort of lands on the free fall side of things.
Yes, indeed. FTX was a supersized free fall, right? Mm-hmm. A month ago, biggest thing in crypto, this powerhouse that's bailing out other crypto companies. And then a matter of days later, it's in bankruptcy court. And as we've reported here on Markets, things are kind of in chaos. The company told the court it has over 100,000 creditors. Its assets are mostly crypto tokens that likely have little value, but it will be very complicated to unwind. And its record keeping is terrible, meaning it's very difficult to figure out even who should get what. Mm-hmm. I suppose if there's a silver lining with FTX, and it's a very thin one, it's that it doesn't look like there's going to be a lot of assets to go around, which in a depressing kind of way makes it easier to pay everybody off.
Mm-hmm. All of the reporting was saying how FTX filed under Chapter 11 bankruptcy. What does that mean?
Yeah, so there are two different kinds of bankruptcies that apply to most corporations. Chapter 11 is for when the company believes it can continue operations and emerge from bankruptcy. Chapter 7 is when all hope is lost, and the plan is basically to sell the company's assets off to get as much for the creditors as possible. Now, FTX filed under Chapter 11, meaning they had some intention of continuing to operate the business, but that's not going to save the company. The court can convert a Chapter 11 filing into a Chapter 7, or it can just approve a liquidation plan under Chapter 11. And I think it's a pretty safe bet that that's what's going to happen with FTX.
And what about Twitter?
Yeah, so Elon has been apparently threatening to employees that the company might go bankrupt. I don't think that's very likely. Twitter is a very unusual case, right? So it's useful to understand Twitter's capital structure after Elon bought it. Elon owns 80% of Twitter, and then a variety of other wealthy entities like Oracle founder Larry Ellison, some large venture capitalists, a Saudi prince. They own the other 20%. But Twitter also has about $14 billion in debt, most of which it took on as part of the Elon takeover. It owes that debt to Wall Street banks. And the payments on that debt are between $1 and $2 billion per year, depending on what happens with interest rates. Plus, Twitter has struggled to make any profit in the past, let alone $2 billion a year. Now, If Elon were a run-of-the-mill billionaire, Twitter's situation would be quite dire, right? They're going to have to come up with $2 or $3 billion a year more than they make for the next couple years in order to pay their debt and keep operating. But because of Elon's vast wealth, which is well over $100 billion, he can potentially afford to keep Twitter afloat indefinitely. And he has every incentive to do so, because as we discussed, if Twitter doesn't pay its debts, its creditors can force it to go into bankruptcy, and they can essentially take the company away from Elon. So if the company goes bankrupt, Elon risks losing not only his 80% stake in the company, right, his new toy, but also the $26 billion in cash that he paid for that stake. So furthermore, I don't think Elon wants any part of running a company while it is in bankruptcy court, right? He's cranky enough about the regular reporting obligations of a public company. He's really not very happy with the SEC. He is going to hate having his creditors and the court looking over his shoulder every month. And the court can really look for anything it wants. So that's not something I think Elon really wants. Now, as Scott pointed out earlier, things start to get interesting if Twitter continues to lose money and Tesla's stock declines. Because with the way Elon has structured his personal finances, he may begin to run into a situation where even though he's worth $100 billion on paper, it's difficult for him to come up with $2 or $3 billion a year in cash. If that happens, though, I don't think he takes the company into bankruptcy because of all of the risks that entails. I think he's still got enough leverage with his creditors to renegotiate some kind of deal. Because the thing is, even if you're a creditor of a company, you'd prefer the company continue to operate. That's your best chance of getting the most money back. Mm-hmm. I think Elon will find a way to keep Twitter out of bankruptcy court. And frankly, the easiest way for him to do that is simply to pay the debt or just buy the debt, right? If he can come up with $14 billion, which he probably can, he can buy the debt away from those Wall Street banks, and then he doesn't owe anybody anything, as long as he can continue to fund Twitter's operations. So if Elon were a run-of-the-mill billionaire, Twitter's situation would be quite dire. But because of Elon's vast wealth, which is well over $100 billion, he can potentially afford to keep Twitter afloat. And he has every incentive to do so, because if Twitter doesn't pay its debts, its creditors can force it into bankruptcy, and Elon potentially loses his 80% stake in the company, along with the $26 billion in cash that he paid for it. Now, where things get interesting, however, is, as Scott pointed out earlier, if Tesla stock drops enough that Elon, while he still has quite a lot of wealth on paper, no longer has the liquidity to come up with a couple $1 billion a year, and Twitter continues to need that much money. However, I don't think that happens. I think before it gets to that point, Elon finds a way to either renegotiate the debt with the creditors or simply buy the debt, right? If he can come up with $14 billion now or soon, before Tesla gets any worse, or by restructuring his personal loans, he can take the Wall Street banks out of Twitter entirely, and then all he has to do is continue to pay its operating costs.
Thanks, Jason. So, Scott, it feels like Elon could just sell Tesla stock, sell $14 billion worth of it, and then he's fine. Is there something else? Is there a worst case scenario here?
Yeah, so I don't think that's the case. I don't think he could just sell $14 billion in Tesla stock. If he sold $14 billion because his required coverage for margin loans he's likely already taken out, he'd probably need to sell closer to $20+ billion in Tesla stock. And now we're talking about the kinds of sales that probably put downward pressure on the stock, increasing the amount of stock he would need to sell to cover his margin ratios. So I don't think he could sell that much Tesla stock, or if he did, it would put huge pressure on the stock and potentially cause that downward spiral that forces him to continue selling more and more stock. So, but I do acknowledge that what Jason said, he has enough money to make the interest payments and keep it out of bankruptcy court. I think going into bankruptcy for him is probably not a good idea, because then he subjects himself to getting outbid and losing face. He's the guy that came in, burnt $31 billion in equity, and then lost it to creditors. So I don't think he wants to risk that. What I do think might happen is he might say after 12 or 24 months of hemorrhaging cash here and realizing there really isn't a path to getting back the equity, that he might sell the company, pay off the debt. I don't know if he can go out and buy the debt, because if I was holding the debt, I think Elon has fucked with so many people, and so many people are fed up with the Musk show, that if he offers them 50 cents on the dollar, I think they're going to say no. I think they'd just rather hold the debt and collect the coupon payment and wait till he offers 70 or 80%. And if he offered 70 or 80 cents on the dollar, that again is $9 or $10 billion, which even for the wealthiest man in the world, because of that cascading effect of every time he sells a dollar in Tesla stock, or every time he needs a dollar, he has to sell somewhere between $1.25 and $2 in stock, which creates more downward pressure, more need for sales. Mm-hmm. So I think he's kind of painted himself in a weird way into a corner. And after hearing what Jason said, I think it's likely he continues to make the interest payments. He can come up with, to your comments and Jason's comments, $1 billion a year in interest payments, and hope for some sort of path to increasing the value here. But just hearing you guys talk about it, I think a decent scenario now is he sells it for enough to pay back the debt in a private transaction and get the hell out of Dodge and blame it on Democrats.
Mm-hmm. With those interest payments, so we're looking at $1 to $2 billion a year, which is still really significant. Is that enough to put, and presumably he'd have to sell his stock to do that. I mean, I don't know if he has $2 billion in cash in the bank that he's willing to just put into Twitter. But do you think that would be enough to put downward pressure on Tesla stock as well if he starts selling his holdings at, $2 billion a year?
Probably not. He can probably. So I don't think the number's $1 billion. I think this company is now cash flow negative because despite cost dropping.
Assuming break even, but yeah.
Right. But despite the cost dropping, I bet revenues have dropped faster. So let's call it he needs an incremental $2 billion a year to keep this thing alive. I don't think he can raise additional equity. I think basically, fool me once, shame on you, fool me twice, shame on me. I don't think anyone's going to take that call right now for additional equity into Twitter. Mm-hmm. But $2 billion a year feels probably manageable. I just wonder if $2 billion a year, plus all the headache, plus all the criticism, I just wonder when he gets fatigued by it. And if Tesla starts declining, at what point does his board, Tesla shareholders, and just generally his flying monkeys start to say, look, boss, maybe you should get out of Twitter. Let's say, let's just call this what it is, take the L and move on.
Mm-hmm. Yeah. Talking about taking the L, what is the worst case scenario here? Do you think in Elon's head the worst thing would be Twitter goes bankrupt, or he is no longer the richest man in the world? What is he trying to avoid in this situation, if anything?
I think a guy like this is trying to avoid loss of face. So the reason why Masayoshi-san continued to pour billions of dollars of good money after bad to bail out WeWork, even though it made no sense, WeWork should have gone bankrupt. That would have been the smartest thing for Masayoshi-san. That would have been him acting as a fiduciary for the Vision Fund. Instead, he didn't want to lose face and have American vultures come in and take the company away from him in bankruptcy court. So he continued to pour, I think he poured another $10 billion into the company to buy out Adam Neumann, who had voting shares, controlled the company. Adam Neumann played Masa perfectly. So I just don't think Elon Musk is willing to endure the loss of face around a bankruptcy. I think he continues to make those interest payments. I think the worst case scenario here is that regulators move in, or that it just becomes such a weeping sore of cash. It becomes a failing business, that consumers get fed up, that employee attrition begins to take its toll, and the thing just becomes a giant flaming bag of shit reminder of what a stupid, errant, manic strategy this all was. I think for him at this point, it's even not about money. It's about reputation. And also, the worst thing that happens here in the short run is it infects Tesla.
Thanks, Scott. Let's take a look at the week ahead. We'll see trade deficit and wholesale inventories data for October. And we've also got earnings from Costco, Lululemon, and GameStop. That meme stock is down 40% from a year ago. Scott, do you have any predictions for us?
Well, I'm a glutton for punishment. Ed, several years ago at South by Southwest, I predicted that Tesla stock would be cut in half. I think it went up 7 or 10-fold since I said that. But I'm going to make the same prediction again, hoping that a broken clock is right twice a day. I think a combination, which again is a self-inflicted injury on behalf of Elon Musk, because he's become so inextricably linked to the Tesla brand, that in concert with a slowing economy and a number of new options in the EV market, I think that a $600 billion Tesla is about to become worth $300 billion. I think the stock gets cut in half. I think the circus that is Twitter and Elon Musk begins to infect Tesla, and the company becomes worth more than the entire German and U.S. auto market, even after it's cut by 50%. I think we're going to see a major drawdown in the share price of Tesla.
Do you have a time frame on that?
I would say the next 6 to 12 months, but I should also disclose I'm not shorting Tesla. I would not trade on my recommendations because the markets can stay irrational longer than you or me can stay liquid. So I'm not putting any money behind this. I don't like to short stocks. I occasionally write options, but Tesla, I probably wouldn't. I don't know. I just
why wouldn't you short? I mean, it's just too dangerous. How hard of a prediction is this? Why wouldn't you short it?
Well, so if it got more volatile, I would probably consider writing calls, and that is you get premium for writing options when a stock is volatile, and this stock kind of steadily goes down or steadily goes up. It's not. I don't think its volatility index is that high. Mm-hmm. And also, and I don't mean to infantilize our listeners, I would not write options unless you model out black swan events where the stock goes horrendously in the wrong direction, and despite that, doesn't really have an impact on your kind of economic well-being. So the way I model when I write calls against a stock is I imagine the stock triples the next morning, and I want to make sure it doesn't take more than 2 or 3% of my net worth. Anyways, maybe I will. If it gets more volatile and I can get more premium for writing calls, maybe I will short the stock. Mm-hmm. But I just and some of this is cognitive bias or confirmation bias. I don't like Elon Musk. I know that comes as a shocker to everybody. Sold my Tesla. By the way, I took a big dump in the passenger seat before I sold it. I don't know how that'll impact resale value. But anyways, back to my prediction. I think this company is massively overvalued, and I think the perfect storm is headed Tesla's way. And also the definition of intelligence is the ability to hold two concurrent thoughts in your mind at the same time. So let's be intelligent. Record earnings at Tesla next year, record deliveries, and the stock gets cut in half.
I like that, yeah. And by the way, what was the breaking point for you on selling the Tesla? When I didn't realize you sold that. When did you sell that?
So Werner Herzog, the German filmmaker, said something really powerful, that a third of Americans would kill another third, and a third would stand by and watch it happen. Yeah. And he's obviously referencing what happened in Germany in the middle of last century. And I've always thought that we shouldn't believe that it couldn't happen here. And I think when Elon Musk, who's arguably the most powerful person in the world right now, spreads conspiracy theory and makes anti-Semitic comments, I think he's really tearing at the fabric of our society. And I just don't feel a need to spend $120,000 on a company that is run by an individual that is not, in my opinion, recognizing his blessings and being more supportive of the Commonwealth.
Yeah.
That's all for this episode. Our producers are Claire Miller and Jason Stavers. Special thanks to Catherine Dillon, Ed Elson, Mia Silverio, and the Prof G Media team. If you like what you heard, please follow, download, and subscribe. Thank you for listening to Prof G Markets from the Vox Media Podcast Network. We will catch you next week.